Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to do our economy show and break it up into 5 segments. So the first segment is going to really look at daily activity indicators, high frequency data points that, how is the new COVID resurgence impacting us, what's happening. And then we're going to look at the U.S. economic data with a focus on housing prices. Then we're going to do U.S. consumer and jobs. And then we're going to do a special segment on global poverty and how has COVID impacted global poverty levels? What does that mean going forward? And then we're going to wrap up with Asia and what is happening overall with global trade, which surprisingly is starting to slow down. So now just kind of jumping right into the daily indicators, here we just want to look at some of these high frequency data points. China has had a little bit of a resurgence, which has been a positive if we consider kind of where things sit. The problem is we think that that's going to start to slow back over as we see some headwinds in terms of what is the PBOC willing to lend. We see lending slowing. We see land purchases slowing. We see some of these adjustments that are just going to be a headwind for investments as we go forward. Plus, we also have the renminbi and the yuan, specifically the yuan, which is strengthening against the dollar, which is just a problem if you consider how our imports going to flow, what's going to happen with exports. And you're also picking up some of the data points from not only Golden Week, but also when we look at the big resurgence of imports as there's some stockpiling ahead of Huawei and what could happen going forward. When we look in terms of the global advanced economic side, we see the trend has crept up, but we actually see those trends starting to slow back down and not slow back down in the sense of going well below 80, but again, kind of hitting this flat line as we see cases starting to resurge and adjustments starting to be made within the local economies. So just touching on the economic activity specifically in Europe and the U.S., here you can see Canada has really come off fairly hard. But the bigger ones is really when we start looking at the UK, which is not only facing the British exit and what could happen with British exit and what could happen overall in trade, but also the pain that's being felt throughout Europe. So we've seen Italy, France, Spain continue to roll over, and surprisingly Germany. So Germany is really starting to come back and has seen the greatest drop if we can kind of consider where they were and where they're heading, not only because of the pressure on COVID, but more so on their export level, where we've seen industrial production start to slow. We've seen toll miles start to come off, and we see some of these headwinds emerging in Germany, which are just much worse, or at least is felt more in other parts of Europe, which is again kind of pull us down. The U.S. has seen a fairly strong trajectory to the upside. Here we think it doesn't really roll over, just kind of flat lines at about this 82%, which is an inherent positive if you consider where we were and where we've gotten to. There remains some headwinds to that, but again, nothing to really pull us down, just more to kind of keep us contained within this level, which again is an overall positive if we can kind of consider where we sit, especially versus the rest of the world. Then the question is going to be, do Europe's issues become the U.S. problem? In terms of, are we looking at our future in terms of new cases, slowdowns? So far the answer is no. We're seeing obviously the impacts in driving and some adjustments in terms of COVID cases, but so far it really hasn't shown any real impacts to the underlying economic data on the manufacturing industrial side, but we are seeing something on the jobs and the consumer side. Rounding it out as we go into just emerging markets, this is where we think that there's going to be a more significant headwind going forward, especially as we see India has had a nice surprise to the upside, but they also have a seasonal surge just given where they sit with the festivals, which I think is going to start to roll back over. But again, not roll back over back to where they were in September, but just kind of move back below 80. The bigger issue is going to be some of these leading countries. If we start looking at South Africa, China, specifically Chile, those are issues that are going to start to kind of roll back to the lower end. And again, just coming down to kind of keep that pressure. And if you think about a lot of these countries export raw materials, and the raw materials just aren't being consumed, just as you have developed markets slowing down, which just is going to be an inherent headwind on the emerging markets overall. But again, you can't ignore the fact that they've had a nice little pop, and it's just the question is going to be, how does this continue going forward? And we think it starts to roll over a little bit, but again, more because we've kind of hit this ceiling, which will be a pressure as we go through the remainder of the year, with the developed markets continuing to slow. And this is why we look at the emerging when we look at Europe and just in general, the Middle East, what's happening. And here you can see just the massive acceleration of confirmed cases. Now, again, there's always a difference between cases, ICU, hospitalizations, ICU capacity, but confirmed cases just based on the data that was used, what was shown previously. This will just adjust consumer behavior. People will shop less, go out less, not go to restaurants, which is why even if you have a curfew, if you shut down pubs and restaurants, again, people are going to inherently adjust the way that they're consuming, the way that they're going about their day, which is going to be the overall headwind. The question is going to be how much of this comes to the U.S. And we've seen an increase in cases, not to this level, nor to, if you just look at the slope, the issue is going to be how much of this is going to result in hospitalizations and some of those problems as we go forward. And that's why when we look at, this was in the EIA show, so I don't want to touch on it too much, but you can see that there's been a change in consumption across the board, specifically in the Eurozone economies, as driving, walking, transit is just inherently rolling over. And it's important to appreciate that this is Apple data. So if you think about Google, and I could show you each country on a Google level, it's already dropping on a 7-day moving average. Apple is obviously the richer or the more well-off sector, and it just goes based on search results, not actual travels. And even that is just coming fully down, which is going to be that overarching headwind if we consider what is happening for the consumer, what does it mean for the local economy, which is why, if you remember to last week when we talked about GDP and headwinds in European GDP, this is really what we were looking at, and this is what we were seeing in terms of those headwinds as we go forward. Now, when we start comparing, contrasting, when you look at just the density problem, so if we look at April to June, you had the cities being hit really hard. So the cities were hit. You obviously had lockdowns, just because obviously if you have a city, you have a density issue. So if there's not enough hospitals for who is sick. But now as we go through into October and as we look into November, you can see it's starting to impact smaller and smaller regions, where the rural, small towns, small cities, and you have people from the city moving out, and this is where we continue to see some of these pressures. Now, the other thing that we have to consider is the cases are rising in the Midwest. And the cases are rising in the Midwest, which is some of the biggest driving areas in terms of miles driven. It's where we have some of the most manufacturing for the U.S. and obviously, the harvest. So that's going to be those impacts as we go forward. Again, still relatively low because this is looking at deaths, but something to consider, or at least keep an eye on, especially if this starts to drift higher as we go through and head into the winter season. Now, when we think about what has been done to try to offset some of this, this is looking again at the European budget deficit, just because I know we talk about it a lot, but I don't know how you can, just based on some of these numbers where it feels as though zeros don't matter when you listen to these politicians talk. And obviously Spain and Italy continue to be under pressure, but it's twofold, because not only are you trying to stimulate, but you're losing tax revenue, you're losing economic activity. So that's why the deficit only increases, which is why the ECB continues to do what it's doing. France continues to kind of creep up in that pressure. And this is, if you look at total Eurozone, you can see that it's almost 8.5%, 8.7% shortage across across Eurozone GDP, which again is something to be concerned about as we go forward. And as we look into 2021, where there's this hope of this huge resurgence, but again, debt is a headwind. We've seen it hit CPI. We've seen it continue to slow down economic activity, which again is going to be the bigger problem. And then as we look at the ECB, can't stop, won't stop. A new all-time high in terms of ECB balance sheet assets. It's not something that we see slowing just based on commentary. Again, not something that we see slowing on a central bank level, specifically in the developed markets. Emerging market issues continue. There's a likelihood that you could see another, I don't want to say surprise, but another Turkish central bank increase. Argentina pressure continues to mount. You could see an increase in rates there, just as there's an issue with inflation. There's an issue with the currency stability, which again is going to be a bigger problem, especially as we look at the emerging markets. And just how do they try to bring in those dollars that they're short just because the issues are only mounting. And even though the issues are mounting, it doesn't matter because the global average aggregate negative yielding debt only continues to increase. So we're now back. I think today we hit a new all-time high, which just took out the 2019 levels. And again, it's just you have this inherent activity where the ECB continues to buy, the BOJ is continuing to buy, which again is just depressing those yields and keeping them negative as they continue to absorb a significant amount of product. And then we do have a chart where we look at how many treasuries the U.S. Central Bank actually holds, or the Fed holds, versus the total that's outstanding. And here's just where, again, when we talk about what's happening, we want to look at the unemployment rate, but we want to look at it globally, because when we want to look at the OECD, you can see that it remains fairly elevated. It's come down a little bit, and just consider the amount of stimulus that has been taken, the amount of just support that has come into the market, and yet we're still here. And you can see that there's been a significant amount of stress, and it's a little skewed based on who's furloughed, who's not furloughed, who has gone from furloughed to permanent unemployment, where you have the furloughs coming down. Some are going back to work, but they're actually transitioning into permanent unemployment. And that's not just a U.S. issue. That is a global problem that has continued to be faced, especially as we look at the Euro area and just the pressure that remains across the area, where the Euro area, that red line, continues to kind of drift higher. The OECD totals kind of leveled off here, and the U.S. is starting to flatten out. And we actually think the U.S. rate's going to start to creep higher. And this is factoring in the amount that we're at the lowest participation rate in the U.S. since the 70s, and it's only going to continue to get pressed lower, especially as we go through the end of the year, where we just don't see that hiring taking place. And again, not just a U.S. problem. This is the global issue when we consider about the consumer purchasing flows on the export-import level, which is why we've seen some resurgence in global trade, but that we think that's starting to pare back, which we'll talk about in the last segment. And here's where we just start to, not if you are working, how many hours are you working? And the problem is working hours continue to get lost. So you may be employed, but how many of you are underemployed? How many hours have been lost? And this is when we look on a global level. So if we look at, the equivalent fiscal stimulus value, so we've gotten stimulus, which has, if we look at a world level, is about 4.3% of the value that's been lost, but the hours lost is 11.7%. So again, even though we've gotten stimulus, it hasn't been enough to offset the problems. And if you think about where we've seen the bigger issues, obviously the higher income areas have seen the benefit just because there's more savings, paying down debt. That has been a benefit, but the upper middle income, lower middle income is where we see the biggest impacts. And that's a huge chunk of consumer purchases, not just in the US, globally, which just won't appear. Now, lower income isn't a surprise. It's just that lower middle to upper middle income, that is where we're seeing the biggest impact. And that's the one that we want to look at and kind of pull apart and really understand what are those issues going to be going forward, because that's the longer term problem. Those are the longer term issues. Then obviously Africa, which we're going to talk about poverty. We actually have that special segment looking at global poverty levels. And then obviously when we look at the Americas, pressure remains just because of Canada and Latin America. And then it's just, again, the hours worked is the biggest issue in terms of what isn't coming back, where even if we do get some resurgence, it's like, well, I don't need to hire someone new. If I can take someone who's maybe working 25 hours a week, I can take them back to 40 and still not hire someone. And we continue to see an adoption of more and more technology, again, replacing the person that's working and maybe shaving hours. Again, this is just the consumer that's going to continue to struggle in terms of that overall purchasing. Now, taking that to the next level, as we look at, well, what can we expect, excuse me, as we go into Q4? And here you can see the baseline is improving. Again, I would say that I'm not that pessimistic. Again, I think we average out. We start to flatline. We just see the slope adjust. So it's not that we're going to be down 8.6%. I think we're going to be down at this point about anywhere from 9.5 to 10%. So it'll be better than Q3. But again, not optimistic, below baseline, but not pessimistic. I mean, that pessimistic view is factoring in a full-on lockdown across the board, which I just don't think that you have the buy-in. So the consumer won't listen. And the companies are like, look, I'm not going to listen to you either because I need to keep my business going. I need to keep cash flow. So no, I'm not going to listen to you. And if you want, you're going to have to come force me, which again, won't happen. Countries, governments, municipalities need tax revenue. They're going to try to avoid it. It's just you're going to have the consumer that's naturally going to adjust. Now, if you get an issue in ICU beds, in those problems again, you will see that increase and you will see that become a problem. But again, it's going to be a slower period of time in terms of when do you see that start to adjust, which is going to be that overall problem. Again, not the pessimistic. I'm still below baseline just in terms of kind of where I see this world heading. And that's when we start to look at, the share of new infections by age, because I think this is an important adjustment in terms of where are people getting infected. I was actually fairly surprised to see in the US that in May, we actually had a higher percentage of that 40 to 59. But when we look at the UK and France as just an example, you can see that it is a much younger crowd, which again comes to survivability, a need for hospitalization. So these are people that are just going to adjust their overall impacts. And at the same time, if you consider the UK and France and the age of the individuals there versus the US, it makes a little bit more sense. But again, these are going to be those continuing headwinds as we have the younger individuals getting impacted, which again is just going to slow down demand, but should reduce total hospitalizations and needs for ICUs. And then, as we talked about, those three locations, honing it a little bit more in terms of new cases, as I've talked about the Midwest getting impacted the most. You can see that this is new cases per 1,000, and just going towards the end and seeing where we sit, you can see the trend is getting negative in terms of going from orange to deeper red, which is the overall problem as we look at those new cases continuing to grow, and they're trending in the wrong direction. Now, as we go into November, we think those are going to continue to shift higher. Again, just causing people to do less, which is going to be an inherent overhang, not only for gasoline demand and oil demand, but also just that manufacturing impact, which is something that we think is going to show itself a bit more as we start to go through the different dynamics of, housing economic data, consumer economic data, and what does the U.S. economic data look like as we start to project into Q4.